Most people think about money in one currency. They earn in it, save in it, invest in it, and plan their future around it. But currency is not neutral. Currencies move. Currencies weaken. Currencies strengthen. And those movements reshape purchasing power, often quietly. Currency exposure. In the previous episode, we examined geography. Now we narrow the lens. Currency. Currency exposure measures how dependent your wealth is on the stability of a single monetary system. If all your assets are denominated in one currency, then your purchasing power depends entirely on that currency's stability. Historical reality. Currency risk is not theoretical. It appears repeatedly across history. In the 1970s, the British pound lost significant purchasing power during a period of high inflation. In the early 2000s, the Argentine peso experienced repeated devaluations. In 2016, following the Brexit referendum, sterling declined sharply against several major currencies. In many emerging markets, currency swings can be even more pronounced. These are not extreme scenarios. They are historical patterns. Silent inflation. Currency risk is not always dramatic. Often it appears as gradual erosion. Let us consider a simple example. If inflation runs at 6% per year and your capital earns 3% per year, your purchasing power declines. Quietly, year after year. Inflation rarely feels dramatic, but over time, it compounds. Now pause for a moment. In which currency is the majority of your capital denominated? Write that currency down. Then ask yourself a second question. If that currency weakened by 20% over 5 years, how would that affect your purchasing power? Would your income adjust? Would your assets hedge the decline? Or would you absorb the loss directly? Currency diversification. Diversifying currency exposure does not require speculation. It simply reduces single currency concentration. This may include holding assets denominated in different major currencies, owning globally diversified investment funds, holding assets linked to international revenue streams. The goal is not to bet against your home country. The goal is to reduce dependency on one monetary system. Let us illustrate this simply. Imagine two individuals. Both hold £500,000 in capital. Person A holds the entire amount in sterling-denominated assets. Person B structures capital differently. £300,000 remains in sterling. £200,000 sits in globally diversified assets with multi-currency exposure. If sterling weakens significantly, person B absorbs less impact. Not because they predicted the movement, but because they diversified exposure. Now reflect calmly. Is your capital earning local returns or global returns? Is your purchasing power tied to a single monetary regime or distributed across multiple ones? Currency positioning is subtle, but powerful. Because currencies shape purchasing power, and purchasing power shapes long-term financial outcomes. In the next episode, we examine jurisdiction risk. Because currency is only one layer of financial geography, legal systems matter just as much.